Hi friends, welcome to the channel JIV and CIV Made Simple. So this is our Unit 6 theory portion, and this is our English video series of BFM. We are covering each and every unit in the English language. I am explaining in the layman terms as simplest term as possible in all these lectures. So today we are going to discuss our external commercial borrowing and foreign investment in India. So these are the topic which will be go through. The first topic, as you can see, is nothing but external commercial borrowing. Then the next topic we will see is ECB, other operational concept, reporting requirement, and finally we will see conversion of ECB into equity. So we will try to break down all these four important topic in this particular video. So let's begin with. So ECB means external commercial borrowing. It sounds complicated. We will simplify it, but don't worry, we will simplify it step by step. So if you are interested in understanding how companies in India borrow money from abroad, you are in the right place. So external commercial borrowing, or we called it ECB, right? So they are just a fancy way of saying that companies in India can borrow money from foreign lender. So it is a fancy way of saying that companies in India can borrow money from foreign lender. Now these loans are mainly for medium to long term. Remember, this is the keyword, medium and long term, right? And meaning they have to be paid back over a few years. So they have to be paid back over a few years. That's the key point. Now, it can be in the form of foreign currency or even in Indian rupees. The minimum time for paying back these loan is usually 3 years. That is called minimum average maturity period. In short, I call it MAMP. What is this MAMP? MAMP is the minimum time for paying back these loan, which is usually 3 months. So three things we have covered. First thing is that foreign lender. What I mean to say, that companies in India can borrow money from foreign lender using ECB. Second thing is that it is applicable. It is given for medium to long term. Over a few years you have to pay, and it can be in foreign currency denominated debt. And the fourth thing is that minimum average maturity period is 3 years, right? So let me make it simple with an example. Imagine there is a company, right? So there is a company in India. Let's call it XYZ Limited. Now they want to borrow money to expand their business. So, but instead of borrowing from an Indian bank, they borrow from a bank in US. So instead of borrowing from Indian bank, they borrow from a bank in US. So this is ECB, basically a loan from a foreign lender. Is it clear now? Now the next question is, who actually take this loan? Remember, who take this loan? This is a very good question. That means this ECB is applicable to whom? So not every company in India can borrow from abroad. Not every company. Only a specific business called eligible resident Indian entities, right? They can only get this ECB, and sometimes they can even borrow for less than 3 years if the project needs it. So they are also eligible to borrow for a period of 3 years. Earlier what I told you, that the minimum average maturity period is 3 years, but these eligible resident Indian entities can also borrow for a period less than 3 years, right, if the project needs it. Now let's move on to that. There are two ways companies can get this loan. So how ECB work? Let's see how ECB work. We will cover in this particular paragraph. So what we have seen till now, the first keyword is that this is raised by foreign lender. This is raised from foreign lender. Second keyword is that medium and long term foreign currency denominated debt, including Indian rupees denominated borrowing. So both are included, foreign currency as well as Indian rupees denominated borrowing. And MAMP is 3 years, but it is possible that this eligible entity can borrow for a period less than 3 years, right? So now let's see how ECB work. So one is called automatic route. There are two way companies can get this loan. The first is called automatic route. So here the bank in India known as authorized dealer category 1, they can approve the loan. So the bank in India who are called AD1, AD1 means authorized dealer category 1. So this bank in India can approve the loan. And the second way is called approval route. So this means that company has to get permission from the Reserve Bank of India, or you can call it RBI, right? So that is called the approval route. So first of all, the route is called automatic, and the second route is called approval. So in approval route, the company had to get permission from the Reserve Bank of India. To do this, they have to apply through their local bank, right? Request through their local bank, and if they get approval, they can go ahead with the borrowing. So, and that's it. Now you know what ECB are, how company borrow money from abroad, and the two way they can get it done. So if you find this explanation helpful, don't forget to hit the like button and subscribe for more simplified BFM content. Now let's move on to the next slide. Hopefully these things are clear in this particular slide, whatever point we have covered. Now let's move on to two important types of external commercial borrowing. The first is called foreign currency denominated ECB, and the second is called Indian rupees denominated ECB. It might sound tricky, but trust me, we will break it down so easy to understand. So let's talk about foreign currency denominated ECB. These are the loan that a company in India takes in foreign currency. These are the loan which a company in India takes in foreign currency. As the name suggests, right, foreign currency denominated ECB. So you can think of US dollar, you can think of euros, you can think of any other currency that can be easily exchanged around the world, right? So as the name suggests, these are the loan that a company in India takes in foreign currency. Now these loans are not just limited to borrowing money from a bank. It's not just that you are just borrowing money from the bank. No. It includes that, but besides that, moreover, they also include things like bond, things like debenture, things like trade credit. We have already covered what is trade credit in the previous lecture, right? Trade credit beyond 3 years, right? If the repayment is for more than 3 years, then only trade credit is included. FCCB, foreign currency convertible bond. Let's make it clearer with an example. So let's suppose an Indian company borrow $1 million from a US bank. So this would be a foreign currency denominated ECB. They will have to pay back in dollar over the time, usually with interest, right? So it not only include the bank loan, besides that it include floating, fixed rate notes, bond, debenture, trade credit beyond 3 years, foreign currency convertible bond, foreign currency exchangeable bond, financial leases. All these are included under this foreign currency denominated ECB. Is it clear now? Now on the other hand, we have Indian rupees denominated ECB. This is where the borrowing is done in Indian rupees. As the name suggests, INR means Indian rupees, right? So this is where borrowing is done in Indian rupees. But here is the interesting part. The interesting part is that it is similar to the foreign currency loan. See, it is similar to the foreign currency loan. This our Indian denominated ECB is similar to the foreign currency loan. You can still take loan, issue bond, debenture, or even enter into trade credit agreement. So as we have seen in the first case, that it can be entered into, it is not limited to just bank loan. You can enter into trade credit beyond 3 years, foreign currency convertible bond, foreign currency exchangeable bond, financial leases, floating, fixed rate notes, bonds, debenture, right? So see, these are the points which I am talking about. So this loan is in, but what is the difference? The difference is that, see, everything is similar, everything looks similar, but the difference is that the loan is in Indian rupees. The loan is provided in the Indian rupees and not in foreign currency. The loan is not provided in the foreign currency, right? The loan is provided in the Indian rupee, that is called INR. So let me give you an example to make this concept more clearer. See, if the same company, as we are talking about in the XYZ Limited, if the same company borrow rupees 10 crore from a lender abroad, see, try to understand. If the same company borrow this rupees 10 crore from the lender abroad, see, when I say lender abroad, then only we are talking about ECB. Is it clear? So he is borrowing from lender abroad, but the denomination of the currency is INR, that is called Indian rupees. So that would be INR denominated ECB. Is it clear now? So see, the difference is that if the same company is borrowing 1 million US dollar from a US based company in this obviously dollar currency, then it will be called FCB. But if the same company borrow from the foreign lender in Indian rupees, it will be called INR denominated ECB. And the similarity is that these ECB can be used for different purposes. What are the different purposes? Like you can issue bonds, debenture, trade credit beyond 3 year, FCCB, right? So both type of ECB can include various instruments like floating and fixed rate note. You know, these floating and fixed rate notes are nothing but they are called bonds, right? They are called, this include trade credit also. It include you know what is the trade credit? When you take longer than 3 years to pay for import. Already we have discussed the trade credit in the previous lecture. You know about import we have discussed their supplier credit, their buyer credit. And if you take the loan, if you pay if you take longer than 3 years to pay for the import, then this is included, right? Remember, beyond 3 years it is saying. And the next is financial lease. You know what is the meaning of this financial lease? Let me give you an example to make this more clear. See, financial lease is that whenever you lease an asset and pay for it over the time. And there are some special kinds of bond which are called foreign currency convertible bond, foreign currency exchangeable bond, which gives lender the option to convert their bond into share of the company. See, as the name suggests, convertible. So what is convertible here? So this convertible is nothing but these bonds can be converted to share at the later date. This company gives the bondholder an opportunity to convert the bond into share, right? So that is called foreign currency exchangeable bond and convertible bond. So to summarize this slide, whether it is foreign currency or Indian rupees, company in India can borrow money in many different way through ECB, that is external commercial borrowing. And now you know the difference. So if you really found this breakdown helpful, gives us a thumbs up and subscribe for more easy to understand BFM content. Now let's move on to our next slide, that is our external commercial borrowing concepts. See, we will talk about external commercial borrowing and we will break down who can borrow, what they can use the money from and what they can't. Let's get started. So first let's talk about who can actually take this loan, also known as eligible borrower. So when I say eligible borrower, I mean to say that who can take this external commercial borrowing loan. So here is the quick list. First thing is companies that are allowed to receive FDI. You know what is the meaning of FDI? FDI means foreign direct investment, right? So those company which are eligible to receive foreign direct investment, you know, this foreign direct investment is a kind of investment which is done by the foreign company in Indian to Indian company, right? So all those entities eligible to receive FDI, so they are eligible borrower. As I told you, there are some eligible Indian resident entities who can participate in this ECB, and that is what list I am providing you. Second is startups. See, the second to the list is startups. So startups recognized by the central government when they raise ECB. So these things. The next is special entities like Port Trust, Unit in Special Economic Zone, SIDB, Exim Bank, etc. And finally, registered entities engaged in microfinance activities. So basically this means that certain companies and financial institutions in India, including a startup and microfinance organization, can borrow money from abroad using ECB. So what we have covered, the four categories we have covered. Let's recall once more. The first category is all entities eligible to receive FDI. The second is entity recognized as a startup by the central government as on date of raising ECB. And the last is Port Trust, Unit in SEZ, SIDB, Exim Bank, etc. So these four entities are called eligible entities, eligible borrower, right? Is it clear now? Yes. So let me go back to the where we are discussing here. Now just because you can borrow does not mean that you can use the money for anything, right? Just because you can borrow, it does not mean that you can use the money for anything. There are something you cannot use ECB for, and that is what we call a negative list. You see this word negative list, what does it mean? It is not like that you are taking ECB and you can use the money for anything you want. No. There are some restricted things, and this negative list lists out those restrictive things. So here it what ECB proceed can't be used for. The first thing is real estate activity. So you can't use the money to buy property or develop real estate. The second is investment in capital market. So no stock market or other investment is allowed. The next is equity investment. You can't buy shares in other company using the money you have borrowed using the ECB. The next is working capital purposes except from foreign equity holder. So this is generally not allowed unless the lender is a foreign equity holder. See, try to understand. The lender should be foreign equity holder, then only it is allowed. Working capital purposes. Next is general corporate purposes except from foreign equity holder. So same as above, unless it is from foreign equity holder, the general corporate purposes is not allowed. And the last not the least is repayment of rupee loan except from foreign equity holder. So what does it mean? So repayment of rupee loan is also not allowed. So you cannot repay the rupee loan except it has not been taken from the foreign equity holder. So what I have told you, see, first of all, you can't use this money for real estate activity. Second thing is you can't invest in stock market. The third thing is you can't invest in shares. And the next thing is you can't use it for working capital purposes, provided the condition is that you have not taken it from the foreign equity holder. That's the point. So that's the point. Hopefully it is clear now. And this general corporate purposes, you cannot use this money for general corporate purposes except from foreign equity holder. And the finally is repayment of rupee loan except from foreign equity holder. So these are the negative list. This shows the negative list. So if you are borrowing through ECB, you need to be very careful about how you use the money. These restrictions are in place to ensure that borrowed funds are used for the productive activities and not for things like speculation or real estate. Right. So this is what we have seen in this particular slide. And last but not the least is on lending to entities for the above activity. Right. So on lending to entities from the above activities. Okay, so that's a quick breakdown of who can borrow through ECB and what the money can't be used for. So if you are looking for more detailed content like PDF, videos, mock tests, you can WhatsApp me on this particular number. The number is shown on your screen to get more detail how to access such type of courses. Now let's simplify for recognized lenders. So we are continuing our series on ECB and we are going to focus on who the lender can be. See what question have been asked in the previous slide, that what the money who are eligible borrower and what the money can't be used for. And now we are going to discuss that who the lender can be. Right. So we will discuss who the lender can be. Let's break it down into simple terms. So when an Indian company takes loan, try to understand what I'm saying. This is quite simplest breakdown in the lucid manner. I am talking to you, I am explaining you. See, when an Indian company takes a loan through the ECB, the lender, basically the person or institution giving the money, has to meet the certain criteria. So what I am saying, so suppose this XYZ Limited, this is an Indian company, right? And it has taken loan from this foreign lender. This is a foreign lender. And it has taken loan from this foreign lender through ECB. So this foreign lender has to meet certain criteria, and let's see who these recognized lenders are. First up, the lender has to be from a country that is compliant with the global standard. So residents should be from a country that is compliant with the global standard, right? So this means that country has to follow the rule of either, first is FATF. FATF is called Financial Action Task Force. You know about this? This group work to prevent things like money laundering and terrorism financing. So the lender has to be from a country that follow this standard. And the second thing is IOSCO, International Organization of Securities Commission. What is it all about? So another group that ensure financial market operate fairly and transparently. Besides from this, apart from above, there are few more types of lender that are recognized under ECB. Let's see those. Here is the list. So first is multilateral and regional financial institutions. So if India is a member of these institutions, they can also lend to Indian company. For example, let me give an example like World Bank, like Asian Development Bank. So these are multilateral and recognized financial institutions where India is a member. So country will be considered as a recognized lender. Next thing is individual as a lender. Try to understand. Very, very good thing. So this is allowed if the individual is a foreign equity holder. Remember, I have just told you in the previous slide regarding this foreign equity holder, foreign equity holder, foreign equity holder. So this foreign equity holder are allowed. Right, if you are taking this working capital, if you are taking this ECB proceed for working capital purposes from a foreign equity holder, you can do that, but not from an Indian but not this Indian equity holder. That's the point. So individual as a lender can also be a recognized lender, provided the condition is that he should be he should be foreign equity holder, or if they are subscribing to bond or debenture listed abroad. Two things. First thing is either he should be a foreign equity holder, and the next thing is if it is for subscription to bond debenture listed abroad. Next thing is foreign branch subsidiary of Indian branch. See, these branches can only lend foreign currency loan. They cannot lend INR ECB. Remember, very, very important. These foreign branches, suppose, let me give an example. For example, SBI. So SBI has a foreign branch in USA, suppose, okay, and suppose there is some subsidiary of SBI in USA. So they are permitted as recognized lender only for foreign currency ECB. So for rupee denominated bond issued overseas, Indian bank branch abroad can participate in other role too. So try to understand what I am saying, that here it is a point. For rupee denominated bond issued overseas, Indian bank branch abroad can participate in other role too, like arranging, like underwriting, like market makers, or trading these bonds. So this is what I explain, that foreign branch subsidiaries of Indian bank subject to applicable prudential norms can participate as arranger, underwriter, market maker, trader for rupee denominated bond issued overseas. So what I am saying you, that suppose there is a rupee denominated bond which has been issued overseas. So for these bond, the Indian bank branch abroad can participate in other role too. So to sum it up, not just anyone can lend money through ECB. Lenders have to meet a specific requirement, and most of them come from countries or institutions that follow in strict international financial standard. So first thing is they should be resident of FATF or IOSCO compliant country. Either they should be multilateral and regional financial institution where India is a member, or individual as a lender can also lend, provided he should be foreign equity holder. So this is also one important condition. And remember that foreign branch and subsidiaries of Indian bank are permitted as recognized lender only for foreign currency ECB. And suppose there is a foreign branch, suppose there is a subsidiary of Indian bank, okay, they are also recognized lender subject to applicable prudential norms. They can participate as arranger, underwriter, market maker for rupee denominated bond. So these are the points which we have covered in this particular slide. So that is the point. Now let's move on to the next topic, that is MAMP, minimum average maturity. So we will talk about minimum average maturity period, or MAMP, when it comes to the external commercial borrowing, or ECB. So I will break it down for you step by step. So let's dive into. So first thing first, what is MAMP? MAMP stands for minimum average maturity period, and it is basically the minimum amount of time a company has to take to repay the loan they have taken from a foreign lender. So this is the minimum amount of time. This is the minimum amount of time, right, that a company has to take to repay the loan they have taken from a foreign lender. So suppose this XYZ company has taken loan from a foreign lender, okay, and obviously since this XYZ company has taken the loan, so it has to repay the loan. So the minimum time that this XYZ company will take to repay the loan, that is called MAMP. Different loan have different MAMP depending on how the money is being used. So as I have already told you, for most of the company the MAMP is 3 years. This includes startup as well. So if you are borrowing through ECB, you generally have 3 years to pay back the loan. That is the point. Now, but if you are a company in the manufacturing sector, you have got little bit more flexibility. Which kind of flexibility? Let's see. So suppose if you are borrowing up to $50 million. Suppose you are borrowing up to $50 million in a single financial year. So MAMP can be just 1 year. So in this case, MAMP can be just 1 year. This means you only have 1 year to start paying back the loan. Right? So you just have 1 year. So manufacturing company may raise ECB with MAMP of 1 year for ECB up to USD 550 million. Okay, or its equivalent. Now things gets interesting if you are borrowing from a foreign equity holder. Why I'm saying so? See, basically, you know who is the foreign equity holder? Basically, someone who owns share in your company, right? Foreign equity holder means he is someone who owns who own a share in your company. That is called foreign equity holder, because he is from foreign and he is an equity holder of your company. That is what it is called, foreign equity holder. So if the money is being used for working capital, see, I have told you this earlier also. If the money is used for working capital, when I say working capital, I mean paying daily expense. If the money is used for, so suppose you have raised money from a foreign equity holder. So this is a person, he has an equity, he has raised an equity in your company, and you are raising money from him, and you are using this money for working capital purposes, miss daily expenses, or general corporate purposes, or even repayment of rupee loan raised domestically, okay, that were borrowed from anything other than capital expense, rather than capex. It is written, you know what is capex? Like buying equipment and building factory. What I'm saying, suppose you raise a loan for buying machinery, you can't do that. But if you have raised loan domestically for any other purposes other than capex, right? So the MAMP is 5 year. See what I am telling you, this is very important thing. Already I have told you that one of the recognized lender can be foreign equity holder. You know what is the meaning of foreign equity holder? Foreign equity holder is none but those person who have hold equity in your company, who had hold share in your company. That is called foreign equity holder, right? So you can raise money from this foreign equity holder, provided the condition is that, and you can also use this money for working capital purposes, for general corporate purposes, or repayment of rupee loan raised domestically for purpose other than capex. And in such case, you will have 5 years to pay back the loan. That is what have been explained. But if the loan is being used for working capital purposes or general corporate purposes, and not from a foreign equity holder, try to understand. If you are using this ECB for working capital or general corporate purposes, and it is not from an foreign equity holder, then MAMP will be 10 year. See, try to understand the difference. If it is from foreign equity holder, MAMP will be 5 year. If it is not from a foreign equity holder, MAMP will be 10 year. Also, if the ECB is being used to repay loan taken from capital expense. So suppose loan you have taken for capex. Capex means what? Suppose for buying machinery, for equipment, etc. So building factories. So if the ECB is being used to repay loan taken from capex, so the MAMP will be 7 year. Right? And if you are repaying loan for non-capex purposes, MAMP will be 10 year. Okay, is it clear now? And for a startup, no matter what the loan is used for, MAMP is 3 year. So that's a quick rundown of the minimum average maturity period for ECB. So the repayment timeline depends on how much you are borrowing and what you are using the loan for. These two things I have covered. Like in the case of manufacturing, you have seen up to 50 million US dollar, 1 year. General condition is 3 year. But if it is from foreign equity holder and you are using for double working capital or general corporate purposes or repayment of rupee loan raised domestically other than capex purpose, it will be 5 year. If the ECB is utilized for working capital purposes or general corporate purposes, then MAMP will be 10 year. But in this case, remember, it is not taken from foreign equity holder. And if the ECB is utilized for repayment of rupee loan availed domestically, for capex and non-capex, it will be 7 and 10 years. It is not from a foreign equity holder, remember. And for a startup, it will be 3 year. So we have seen this MAMP. Now let's move on to the next slide. So we will talk about something called all-in cost ceiling when it comes to external commercial borrowing or ECB. These terms sound complicated, but we are going to break it down into easy to understand terms. So let's jump in. So all right. So what exactly is all-in cost ceiling? Simply put, it is the maximum amount of interest and other cost that a company can pay when borrowing money from abroad. So let's come back to our XYZ company. This company is borrowing money from abroad. So the maximum interest and other cost that a company can pay when this XYZ company will borrow money from abroad. These costs are calculated by adding a few things together. Like, first thing you will add interest rate. The second thing you will add other fees. What are the other costs? What are the other fees? So let's go over the specifics. See, for new ECB, what did it say? For new ECB, for new external commercial borrowing, the total cost a company can pay is the benchmark rate plus a spread of 500 basic point or BPS. Now, if you are wondering what is this BPS, let me explain. 1 basis point is 1 by 100th of a percentage point. So 500 BPS means what? 500 BPS means the cost can be 5% higher than the benchmark rate. See, I have told you what is the meaning of all in cost ceiling. It means what amount of interest and what other cost the recognized borrower, the eligible borrower, is paying to the recognized lender, right? Whenever he borrow money from abroad. So in this case, if it is a new ECB, it will be benchmark rate plus 5% extra, which is spread, right? And let's talk about ECB that were originally linked to LIBOR. See, earlier it was linked to LIBOR. For those ECB, you know what is a LIBOR? It is a global interest rate standard. Since LIBOR is being replaced with something called ARR, already I have discussed in this ARR, that is called alternate reference rate, the rules are slightly different. And in these cases, the total cost a company can pay is benchmark less plus 550 BPS. So it is 5.5%. In simple word, you can say this is nothing but 5.5%. So what if the loan is in Indian rupees? See, these are in foreign currency denominated currency, and if it is Indian denominated ECB, the cost is benchmark rate plus 4.5%. But here is the catch. Benchmark rate for rupees loan is based on current interest rate on Government of India securities with a similar maturity period. So this benchmark rate, how it is decided? So suppose there is a similar Government of India security with similar maturity. Suppose its maturity is 4 year, and there is a Government of India security is for 4 year maturity. So whatever prevailing yield the government is providing, the benchmark rate will be the same. Now if the loan has a fixed interest rate, that is called fixed rate loan, things work a little differently. In these cases, the cost is calculated by adding the swap cost. Swap cost is added. What is the swap cost? Swap cost is the cost to change a floating rate to fixed rate. See, this is extra cost which is borne. So if you have to change this floating rate to fixed rate, this swap cost is added, right? Swap cost plus an spread. Swap cost plus a spread, right? So that is the point. So the total cost should not be higher than what you would pay on a floating rate loan plus the same spread. So in the case of fixed rate loan, the swap cost plus a spread should not be more than the floating rate plus the applicable spread. And lastly, let's talk about foreign currency convertible bond. So that was the case of fixed rate loan. Now let's talk about this foreign currency convertible bond. These are the bonds which you can convert into share at the later date. So the cost related to issuing this bond can't be more than 4% of the amount raised. So for FCCB, the issue related expense should not exceed 4% of the total amount raised. But if it is done through a private placement, suppose it is done through the private placement, right, meaning it is sold directly to a few investor instead of the public, the cost can't exceed 2%, right? So that is what is the meaning of private placement? Private placement means it is sold directly to a few investor instead of to the public. It is not sold publicly, rather it is sold directly to a few public, few individual, few investor. So in that case, these expenses should not exceed 2% of the issue size, right? So now that's the lowdown on the all-in cost ceiling for ECB. The important thing to remember is that there is a limit to how much company can pay when borrowing from abroad, and it varies depending on the types of loan and currency. So if this video help you clarify things for you, don't forget to give it a thumbs up and subscribe for more simplified BFM content. And friends, the next part will be applicable to our paid member. If you want to get access to more videos like this, please WhatsApp me on this particular number. I will provide you detail how to access the course. Thank you.